everyone, and welcome to the investor update for the Perpetual Equity Investment Company, or PIC, as I will refer to from now on. My name is Karen Davis, and I look after investor relations for PIC. Thank you for joining us for the next 45 minutes to an hour, where we will give you an update on PIC and provide you with the opportunity to ask questions. Wherever you may be dialed in from today, I hope you and your families are well. We particularly want to send our well wishes to those that are joining us from Victoria. Our thoughts have been with you during this latest lockdown. To start, I just have a bit of housekeeping. All participants will be in a listen-only mode during the presentation. Everyone who registered for this update has been emailed a slide pack this morning. If you have not received the slide pack, please visit the company's website, www.perpetualequity.com.au, and you can download the presentation from the ASX announcement section. We'd encourage you all to ask questions today. You can submit your question at any time during the presentation. We'll aim to get through as many questions as possible at the end of the presentation. If you're logged in via the webcast, please click on the Ask a Question tab on the top right corner of your screen and submit your question. If you wish to ask a question by the phone, please press the star key followed by the number 1 on your telephone keypad. Before we begin, please kindly note the important information that accompanies today's presentation. Today, I'm joined by Nancy Fox, Chairman of PIC, and Vince Pezzullo, Portfolio Manager of PIC, and also Deputy Head of Equities for Perpetual Asset Management Australia. Nancy will start by giving you an update on the company and also outline the details of the share purchase plan and one-for-one bonus issue of options the company announced last Wednesday, the 2nd of June. You will also have the opportunity to hear from Vince Pezzullo, Portfolio Manager of PIC. Vince will provide information on market conditions, how he has positioned the portfolio, and the investment performance. I'll now hand over to Nancy.
Thank you, Karen. For those of you who might not be as familiar with the company, I will briefly provide you with some background information on the company and its recent performance. I will then turn to the share purchase plan and bonus issue of options that we announced on Wednesday, the 2nd of June. PIC was listed on the ASX in 2014 to help investors conveniently access a portfolio of high-quality Australian and global securities. Since then, PIC has grown to a market capitalization of $458 million. The company continues to deliver on its investment objective of providing investors with an income stream and long-term capital growth in excess of the benchmark over minimum 5-year investment periods. The manager undertakes an active management style of the company's investment portfolio, with a focus on value and quality. The manager applies 4 quality criteria when assessing companies for investment: quality of business, conservative debt, sound management, and recurring earnings. It will determine what it believes to be high-quality companies and then aim to buy these companies when they are trading at prices below what it perceives to be fair value. At least 50% of the portfolio must be in Australian listed securities. Up to 35% of the portfolio can be allocated to global listed securities, and up to 25% can be invested in cash. However, I'm sure Vince will mention later that he has had low cash holdings recently, given the numerous opportunities he has identified in the market. In practice, the active management style means the investment team, which includes Vince and a large team of analysts and portfolio managers, are actively looking for opportunities in Australia and globally. The flexible investment guidelines enable the team to adapt the portfolio to changing market conditions, which can be particularly important during periods of market volatility. Turning to the next slide, we have been encouraged by PIC's performance. PIC board is proud to have delivered fully franked dividends to shareholders each year since inception. In February, we announced an interim dividend for FY21 of 2.8 cents per share, which was consistent with the FY20 final dividend. This translates to an annual dividend yield of 4.3% and grossed-up dividend yield of 6.1% based on the closing share price of $1.31 as at May 31st, 2021. We believe this represents an attractive dividend yield for shareholders, particularly in the context of current market conditions. On to performance. We are encouraged with the strong investment portfolio performance we have seen recently, with a return of 38.6%, outperforming the benchmark S&P ASX 300 Accumulation Index by 9.9% for the 12 months to May 31st, 2021. At the same time, the share price has increased, with the closing share price reaching an all-time high of $1.32 on June 1st, 2021. This has translated to a total shareholder return of 49.1% for the 12 months to May 31st, 2021. This compares favorably to the benchmark, which returned 20.4% for the same period. The manager considers that current markets provide further investment opportunities, and the board believes it is an appropriate time to look to grow the size of the company for the benefit of all our shareholders. On Wednesday, June 2nd, the company announced a share purchase plan and bonus issue of options. I will talk now in more detail on each of these offers. Turning to the next slide on the SPP, or the share purchase plan, that we announced on June 2nd. Eligible shareholders are able to purchase up to $30,000 worth of PIC shares without incurring brokerage or transaction costs. There are 13 different parcel sizes. You can take up as little as $500 or scale up to $30,000. The issue price of the SPP will be the lower of $1.28, which represents a 2.5% discount to the closing share price of PIC on the SPP record date, which is June 1st, or a 2.5% discount to the volume-weighted average price of PIC shares traded in the 5 days up to and including the SPP closing date, which is expected to be on June 17th, 2021, and will be rounded to the nearest cent. We have set the issue price of the SPP at a small discount to the current share price. We also considered the potential for market volatility while this offer is open when structuring the issue price of the SPP. Shares issued under the SPP will be entitled to any financial year 21 final dividend, which will have a record date of September 29 and would be paid in October this year. I'd also like to mention that all PIC directors that are eligible to participate in the SPP, including myself, intend to participate. So moving on to the next slide on how to apply for the SPP. The SPP is open for 2 weeks and is expected to close next Thursday, June 17, at 5 p.m. Sydney time. We strongly encourage all shareholders that would like to participate to apply online via BPay through our registry, Link Market Services. This is the fastest and easiest way to apply and is recommended in light of potential delays to postal services. For shareholders that elect to receive communications electronically, you would have received an email from Link, which includes your personalized SPP reference number. Please click on the link that takes you to the SPP offer site, enter your HIN, SRN, or SPP reference number, and proceed to reading the SPP offer booklet. You can then select your parcel size and make the payment via BPay. You can also access the SPP offer site by going to the PIC website at www.perpetualequity.com.au. The homepage has a link to the offer site. The other option to apply to make the payment by check. Shareholders that elect to receive communication by post would have received a personalized application form attached to the back of the SPP booklet. Please complete this form and send it to the registry along with your check. If you have any questions, please contact Link Market Services, whose details are on the screen now. Moving on to the bonus issue of options. In conjunction with the announcement of the SPP, we also announced a one-for-one bonus issue of options to all eligible shareholders. Existing shareholders or new shareholders that come in between now and the record date of the options, which is June 23, 2021, will be entitled to options. Importantly, shares issued under the SPP are entitled to the options. Assuming you are a shareholder on the options record date, you do not have to take any action to be issued the options. The board considered the issuing of bonus options to be an opportunity for existing shareholders to participate in the potential growth of the company. They are being issued at no cost. The options have been set at an exercise price of $1.35. This represents PIC's NTA pre-tax as at the 27th of May, 2021. The expiry date of the options is September 2nd, 2022. This means you can choose to exercise or sell your options on the ASX on or before this date. If you exercise your options, you will be entitled to any future dividends declared by the company. As an example, if you exercise before 29 September 2021, you will be eligible to receive any FY21 final dividend where declared. Moving to the next slide. Why we have announced an SPP and bonus issue of options. The manager is of the view that current market conditions provide attractive opportunities for the active value style of investing that has underpinned the manager's approach since the company's inception. This is reflective of the portfolio being almost fully invested, holding just 1.7% in cash as at May 31st, 2021. The SPP and bonus issue of options provide the potential for enhanced liquidity for shareholders. As the company's size increases, it is expected the liquidity in the company's shares traded on the ASX should also increase and may generate further interest from new investors, brokers, analysts, and financial advisors. Greater scale in the company will also benefit shareholders by reducing the company's fixed expense base on a per-share basis. I would also like to mention that the company and manager are aligned through the sharing of the costs of the options issue. Approximately 50% of the total expenses relating to the issue of options will be paid by each of us. Lastly, I mentioned that shares issued under the SPP and bonus options exercised will rank equally with PIC shares and be entitled to future dividends where declared. Before I hand you over to Vince, this is a reminder of the key dates of the offers. The closing date of the SPP is next Thursday, 17th of June, 2021 at 5 p.m. Shares under the SPP will be issued on the 23rd of June, 2021, which is also the same date as the record date of the options. Options are expected to be issued on June 29, 2021, and will be available to be exercised or traded on the ASX from the 30th of June, 2021. Once issued, you can exercise or trade your options at any time up until the 2nd of September, 2022. If you have any questions about the offer, please feel free to ask a question now or contact Link Market Services. We also just released the PIC investment update and NTA report on the ASX today, so please have a read should you want more information about PIC. Thank you for your support of PIC, and I will now hand you over to Vince to provide an investment manager update. Over to you, Vince.
Thank you, Nancy. Good afternoon, everyone. Today, I thought we'd just review the last 12 months and review parts of the portfolio and look at our positioning for the next 12 to 18 months. So if we look at the market progression for the last 12 months, since March 2020, the market has progressed from trying to ascertain the depth and breadth of the recession to being caught off guard by the speed of both the monetary support, but more importantly, the scale of the fiscal policy response. For the last several years, the market has been comfortable with assuming rates would remain low for years ahead, and this has been consensus thinking. But due to the effectiveness of central bank aggressive monetary response, but more importantly, the scale of the government response to self-imposed slowdown, the market quickly began to price in the reflation by about October 2020. The recovery was showing significant strength due to reopening of economies and an avoidance of high and persistent unemployment, which typically marks every recession. Market expectations for inflation are to be more transitory and for conditions to normalise back to pre-corona levels of low inflation and low rates. But several elements of the US CPI will begin to feed into the averages over the next coming months, in particular rent and shelter, which chief being amongst them, which will again focus the market's views on tapering and what could be persistently higher inflation. Whilst elements will seem transitory, when you're living through it, it will feel permanent, and this can lead to changes in inflation expectation. This can be seen in significant supply chain stress in multiple sectors, and we're seeing some of this behaviour due to hoarding of certain materials at the moment. Why is this occurring? The answer to this is that the developed markets are entering a period of fiscal dominance, which is similar to the 1940s and the early 2013, whereby the governments run significant fiscal deficits in response to a crisis, and there is a debt swap from the private sector to the public sector. And due to this, the ability of the government to start paying back these debts are a secondary consideration. To cope with this, debt monetisation is the only solution. From an economic and political perspective, and inherent within this, inflation is usually produced. Why this is having a larger impact in this cycle is that not only is there less productive capacity in the West in multiple industries such as steel, cement, aluminium, and even computer chips, as significant amounts of capacity have been removed as emerging markets built new capacity in these industries from the mid-1990s. This is coupled with more recent use of tariffs on imports of those materials in emerging markets due to the evidence of dumping, but the main difference in this cycle is, given the disruption of supply chains over the past 12 months, companies have discovered how exposed they are to a single supplier, and therefore supply chain security is far more important. We are moving from inventory management systems of just-in-time to just-in-case. This adds to more shortages as global supply chains are adjusted, but it also adds to costs as manufacturing is localised or sent to geographies which are less efficient. We must also consider what a decarbonising future may look like. Does having an exposure to manufacturing or importing from countries that have high carbon costs lead to tariffs on the importing company's goods to discourage imports from those countries, and favouring developed market localised industries that are more willing to invest in newer technologies to lower emissions? This is entirely possible and is already occurring. For example, Intel is building a computer chip fabricating plant in North America, the first one of its kind in a long time. This can be seen from moves by the European Union in recent months. The EU has an emissions trading scheme which prices carbon. This forces higher costs on domestic manufacturers, which weakens their relative cost competitiveness versus imports. Due to this distortion, the EU is likely to apply import taxes on goods from high-emitting countries. For example, the EU just announced carbon border adjustment taxes, which look set to protect local industries so that they may be able to invest in those newer technologies and remain competitive. If you import from a country into the European Union from a country which is a high emitter to get around higher priced domestic goods, a tax will be applied to those imports to take away the opportunity for arbitrage, and thereby protecting the domestic industry and allowing the domestic industry to invest in what are arguably higher cost of decarbonising technologies. Historically, any change to regulation which attempts to change the way business operates has traditionally been inflationary, as those costs are typically passed on to consumers via higher prices. So what is the setup for 2021-22? In particular, what is the setup for tapering and the likely investment implications? The history of tapering on its own is unlikely to be directly useful, since sectors' returns must be assessed relative to the key drivers inputs at the time. Not every taper is the same. Taper 21-22 will likely be distinctly different from the average taper over the past 10 years, since inflation, real yields and yield curves are expected to rise and valuations are already much, much higher than the average. So let's look at the key drivers and inputs. So the backdrop for taper 21 versus more recent episodes in 2013 and 2018 as a backdrop. Inflation risk is likely to be intermediate and more persistent compared to 2013 and 2018, where inflation was much more transitory. Real bond yields are more likely to rise higher than the 30 to 60 basis points, which occurred in 2013 and 2018, and the yield curve is likely to steepen, similar to 2013, but much different to 2018. But more importantly, though, the starting point for growth versus value ratio is already at 2.7 times versus 1.2 times in 2013. That is, growth stocks are 3 times as expensive as value stocks as a starting point, whereas in 2013, they're only 20% more expensive, which will likely lead to increased sensitivity to rising real yields and inflation. For example, higher multiple long duration stocks will have outsized moves due to starting out valuations being already elevated, and any rise in those yields will have outsized impact on valuations to the downside. So the economic backdrop expected for 21-22 will be steepening yield curves, which typically benefits cyclical exposures. So what else are we likely to see? Steeper yield curves due to persistent inflation concerns, less Fed buying and support, but this will likely be dampened by things like Operation Twist and other support mechanisms like increased repo activity. There'll be a hawkish acceleration in inflation in coming months and intermediate nature, with a new regime of fiscal dominance and monetisation with large increases in fiscal spending. Plus, in this cycle, the banks are well capitalised, so they'll be able to provide the credit multiplier to the economy. The last 30 to 40 years of China imported goods deflation theme is likely over due to localisation versus globalisation, as well as just-in-case inventory versus just-in-time inventory. We're also entering a period of weaker China growth relative to developed markets. This is due to credit tightening in the near term and stronger relative fiscal programs in developed markets. We expect to see the ISM manufacturing decelerating from extremely high levels today, but still remain in expansion phase of about 55 or greater. Since inventory rebuild will likely remain, but a shift from services to goods demand on opening up in Northern Hemisphere, coupled with an increased infrastructure spend, will be large due to fiscal dominance. Also, US housing demand could persist due to pent-up underbuild post the 2009 recession and millennials starting to form new households. We will see some risk to materials due to China slowing, but robust US developed market growth is expected to underpin metals demand, particularly around green policies, which are inherently more metals intensive. We expect nominal bond yields to rise between 30 and 60 basis or greater to December this year. The yield curve will steepen, which is problematic for duration assets, since we are at a break point of 1.5% already on the long bond in North America. As rates go above this, duration assets will start to struggle. The Fed will likely limit liquidity reduction via potential implementation of yield curve control, as has been used in Australia successfully to prevent a significant spike in yields, but this will maintain growth in inflation. So in summary, the 2013 taper best remains as the best comparison, so we expect more yield curve control suppression to maintain short rates at a lower rate and pressure on long duration, high PE stocks. This situation is quite similar to 2013, however, with less yield spike and more inflation in our view, even though real yield starting points are comparable. Valuations for duration assets are much more stretched than 2013 of growth versus value, and it's currently sitting at 2.7 times as previously mentioned. Similar to 2013, the ISM and China credit have likely peaked and are softening. Like 2013, we expect a steepening from low real yields, and stretched growth valuations is the main difference. Higher inflation and pricier PE valuations are likely the key differences. In 2013, inflation was dropping and valuations were cheap, so tech and health actually did well because EPS was expanding. In 2021 and 22, we expect valuation headwinds to overshadow EPS growth for high PE stocks. Our base case remains that we see a steeper yield curve, inflation surprises, and higher real bond yields during this taper, with robust but slowing growth. This suggests more long duration pressure versus ongoing, albeit slowing, growth. So how are we positioned? We favour pro-rate cyclicals. Things like insurers. We're positioned in IAG and Suncorp plus Austbrokers. We prefer materials, in particular those that are exposed to any sort of greening policies, so copper, nickel, etc. So we're exposed to Oz Minerals, Iluka, Western Areas and Deterra. We still like energy, as CapEx budgets have been underinvested in and have been declining in exploration, in particular in the oil sector, and there is potentially shortages as most fields are declining in the oil sector. So we have a preference for oil search. While it's a gas play, it is linked to the oil price, and we prefer cyclical values, so BlueScope, Fletcher Building, which anything that basically benefits from fiscal largesse. We also like REITs for the first time, even though they traditionally, in a rising rate world, will struggle, because basically REITs for the last 12 months have performed like cyclicals rather than defensives. So we prefer things like Dexus or Mirvac. Things we are definitely underweight are gold. We are quite nervous about tapering we'll have on gold because it may lead to strengthening US dollar, high PE tech, and anything especially with low ROE and a bad balance sheet, and particularly long duration stocks like infrastructure. Thank you very much for listening, and now I'll hand back to Karen for Q&A.
Thanks, Vince, for that update. So we've had quite a few questions coming through, so thank you for all of your input. The first one I'll go to, we've had about 3 questions on this topic. Just on the topic of inflation, Vince, how are you thinking about positioning the portfolio in the context of the current environment?
Thanks, Karen. So inflation, traditionally you want to be obviously exposed, I did talk about it, but you want to, a bit more specific, you want to be exposed to companies that have an ability to pass on. So if they've got a very strong intellectual property position, etc., or something like an agency type business where they are getting a percentage of selling a product, and if that product's inflating in cost and price, their revenue will grow with that, like gross margin expansion in that. So retail is a good way to think about that. If there's inflation goods, the retailers get a benefit out of a growing top line because they're getting a sort of a fixed margin out of it, and they've got also quite a bit of pricing power themselves, particularly in markets like Australia where it's quite a consolidated retail market. Things also like Deterra, which is an iron ore royalty. They get all the upside of the iron ore price, none of the problems of actually building the mine and or financing what will typically be now, because of quite tight labour markets, and particularly in mining, cost push inflation in those markets will be quite high. With Deterra, they get the benefit of a 1.232% royalty of the revenue line of mining area C, which BHP is expanding. So things like that, they have no costs technically. Companies like Austbrokers, again, that's an insurance broker for SMEs, again, an AG style business. So again, they benefit out of an insurance hardening cycle, which is what we're going through right now, particularly post-corona with business interruption claims, etc., pushing up premiums. So they're the sort of companies you want to look for. They're the type of companies we actually already own. We also have some metals exposure. More importantly, you want to be in, particularly when we start to think about that tapering, when rates start to get pushed up, you want to be, commodities can weaken a bit on the back of that because the US dollar typically will strengthen in that environment. But you want to be in metals which are structurally short. So copper is the perfect example. At this stage, for the next year or two, it may be longer than that, as we mentioned about electrification, etc., there's probably quite large shortages in copper developing, so they are structurally short markets, so price will probably hang in there a bit longer. But you've got to be very careful about that because you want to be exposed to the sort of miners that actually can control their cost base. They're very good miners. So it would be helpful when you've got assets in Australia in particular. It's a bit lower geopolitical risk, but also Australian miners are grade A miners, tier 1 miners. They are very good. They invest in their business properly and they can control their costs better than most.
Great, thank you, Vince. I might also ask a question now to Nancy. So this question is from Liz Nancy, and she's asked, please advise if you expect to maintain the PIC dividend with the SPP and assuming most of the new options are taken up.
Thanks, Karen, and thanks, Liz, for that question. From the board's point of view, we believe that the company's profit reserve balance that we currently have provides strong coverage to provide for future dividends. We're very aware of the impact that this has on our ability to pay a fully franked dividend because of the potential increase in shares, as well as if the options are exercised. Just to give you an idea, on December 31st, 2021, the profit reserve was $53.6 million, and then it reduced to $43.9 after the 2021 interim dividend. We work very closely with the manager, and they actually manage their franking credit balance, and they consider that when deploying the additional capital that'll be coming in. Thank you.
Great, thanks, Nancy. Just also a question for Vince now. So last year, the company increased your ability to invest in global stocks up to 35%. How are you thinking about positioning the portfolio with global stocks at the moment?
So at this stage, we've been pretty consistent with our views of the stocks we currently own. So we have Flutter, again, it's more of a call. It's an online sports bookmaker. It's a global business. We're obviously buying Flutter for exposure to North American sports betting market as it opens up. That hasn't changed. There's a bit going on with Flutter at the moment. Fox Group is trying to, they have an option over the asset that Flutter owns, which is FanDuel. They own 95% of it. Flutter owns 95% of FanDuel, which is a sports betting asset in North America. Fox Group has a chance to buy up to 18.5%, and they're sort of having an argument about price at the moment. We're of the view that if they pay a market price, it's a significant windfall, and if Fox want to pay that price, it's a significant windfall to Flutter. But we'll wait for that because I think it's ongoing at the moment. FDJ has done everything we expected of it. French lottery operator recently listed in 2019. We participated in that listing. We used last year to double down on our holding and increase our holding materially. The management has executed flawlessly in that period. They've actually been able to grow online lottery sales from 2 to 10% in the last 12 to 18 months. Again, I think I've talked about this before, prosecuting the case that it's online lottery sales are vastly more profitable, given you're not paying away the commission. So in Australia, it runs at about 35%. Tabcorp online lottery sales represent about 35%. In Europe, it's about 40 to 50%. They're sort of the numbers we strive for. So we still think there's a little bit more upside. We do actively manage the position, though, for when it gets a little bit stretched. It stays a core holding, so we will manage around that position. We also have what I'll probably put in the bucket of wholly UK-exposed companies. So within that, you've got Lloyds. It's a retail bank only. It doesn't have global operations. It's a retail banking franchise in the UK. Many people would know that. We quite like the UK still. It's coming out of some pretty savage headwinds in Brexit. They've gotten through that now. It's basically implemented. And obviously, they've had harder lockdowns than most. And the economy's sort of opening up. I think they were talking about June 21. That might get extended. Not too sure at the moment, but I would imagine there's quite a bit of pent-up demand in that economy to open up, particularly post-Brexit. And you want to look at the performance of CBA. You want to be in the retail focused with a strong deposit franchise and plenty of capital in particular. All the UK banks did cut their dividends to effectively zero. That's not uncommon last year. We expect they got so much capital that we expect a pretty strong resumption of dividends out of Lloyds. Our other purely UK exposure is Persimmon. We've talked about this in the past. Nothing's changed. Again, there's a new CEO in there. They are basically a house and land builder with 7.5 years of land bank. They get a return on capital of about 40%. Because they do run a net cash balance sheet, that's the secret to this, is that they're able to buy when things are going quite poorly in the market. In the housing market, they can buy tracts of land at the lows of the cycle, but more importantly, they can hold that land for a cycle, because it is a holding cost. You are having to finance an asset which is not actually adding any value to you. And that allows them to buy at the right price and hold that land and then release those margins as they zone it, start developing the product over seven odd years. So particularly given they've got about £800 to £900 million on the balance sheet in net cash position, it protects the business a bit. There's a new CEO in there who's, I think, going to tighten up the process within Persimmon and maybe improve the execution a bit, which should add to actually being able. They do about 15,000 lot sales a year. We think there's scope for them. They are actually a vertically integrated builder. They own their own brick plants and tile plants. The UK imports its own bricks. So we understand that brick plant is operating at 50% utilisation. It sounds a bit crazy to us. So we understand, in speaking to the CEO, he wants to leverage up that business, not financially, but leverage up the operating assets a bit in a smarter way, etc. There's plenty of levers they have to improve the returns. I know it's 40% returns, but I think we can probably grow the business a bit quicker. So we still like Persimmon and Persimmon and Lloyd's for the UK exposure. The other position we are currently running in and investment is Ferguson, bought a while ago. It is they took the path after some activist shareholders got in there. They have effectively 95% of their businesses in North America, Canada, and effectively Canada and the USA. They are a specialty distributor of plumbing supplies, a bit like Reece in Australia, if anyone knows what Reece is. Australian, we've owned that at Perpetual for 15 to 20 odd years. But they are effectively 15% odd market share in the US, high returning business. I think the return on equity is about 20%. It's trading on about 20 times, which is a bit up there on multiples. But given the earnings created last year because of no activity, we think through the cycle margins are actually reasonably sustainable and they're slightly improving them. But they are a tier one operator. They've got a very good balance sheet. They can continue to grow in the US. They do acquire smaller distributors in the US and tuck them into their significantly large distribution platform. One of the stats we believe is I think they had their fulfillment from their manufacturers into their DCs over the last 12 months running at about 50%, but their fulfillment into their customers was running at 90%. So actually Ferguson's has been running a long inventory position for the last 12 to 18 months. A lot of their competitors are in no such position to actually hit those metrics. We actually think they're taking market share in North America. This is all while you're getting actually non-res construction is actually really weak in North America at the moment. Because of the lockdowns, there's no one's committing to building office towers, doing any large-scale projects. But we're actually starting to see the benefit. We're starting to see early signs of an improvement. The Architectural Billings Index, the ABI, has started to go into positive territory. That's usually a lead indicator for non-res construction. Ferguson's is 30 to 40% non-res construction. So we think there's still quite a few tailwinds to that. I think they'll complete their full relisting in North America by the first half of next year. So when it gets to that, as I said, it's trading on 20 times. A lot of their peers in North America, the special distributors, are trading on 40 to 50 times. So I don't believe they should trade up to that because it's a bit crazy to us, but we think there could be an expansion in the multiple there as well.
Great, thanks, Vince. Just a follow-on question from Frank. Are there any other international markets besides Europe, UK or USA that you're considering? And we've also had another question from someone else around whether we've actually got any exposure to Japanese equities.
Okay, so we are currently looking at some potential exposures in the EU. More from the experience we've gained watching the opening up of Australia. There are some assets and businesses in the European Union which they're lagging quite significantly in the economy. They are still pursuing a quantitative easing strategy. They've actually, for the first time, discussed increasing fiscal expenditure, which is, they've lived through 10 years of austerity. So then to consider that means that I suspect if they pull the trigger, it'll be quite large. So we're looking at certain cyclicals in Europe which are trading at pretty big discounts. to what we consider to be fair value for those businesses. We've had a few calls in Europe so far. We haven't done anything yet. We're still building the investment case out, and we've got to get, before we buy offshore positions, we want to be really comfortable with the management, that they're going to do the right thing by the shareholders, and that's usually looking at the history of the business. And then once we have a chat to management and solidify some of our views, we'll pull the trigger. You know, we can move pretty quickly when we need to. Particularly in Europe, there's quite a few industrials which are looking quite cheap through the cycle. On the Japanese question, we haven't really got any at all at the moment. It's always a fascinating market, Japan. I prefer to say I'm not an expert in Japan, so we've got a significant opportunity to invest offshore. So for things to enter the portfolio, we do quite a bit of legwork to understand how it fits in the portfolio in particular, given our existing positions. And don't forget, we have 75% in Australia at the moment. So given the franking, we always prefer to buy something in Australia sometimes if there's a strong dividend payer, just because of the franking benefit as well. So, but at this stage, nothing in Japan.
Great, thanks, Vince. Nancy, I might just throw a question to you. So we've had a question from Robert. He's asked about the SPP closing price, and he said it's a bit unusual that the SPP closes before we know the final price, and just asking about that and why we didn't make the closing date after the share price date was known. So if you can just comment on that, that would be great.
Thanks. That was from Robert, huh? Yeah. Thanks, Robert, for that. Let me just clarify. The issue price of the SPP is the lower of the 2.5% discount to the closing PIC share price, which was on the record date, which was June 1st. So that was $1.28. So it's a lower of $1.28 and a 2.5% discount to the volume weighted average price, the VWAP, of the PIC shares for the 5 trading days up to and including the SPP closing date, which is the 17th of June, rounded to the nearest cent, to be precise, right? So basically what you have is a maximum of $1.28. So when you actually submit to buy those shares, the maximum price that you'll pay is $1.28. So you do know. So if anything, you know, it's going to go the other direction for you.
Great, thanks, Nancy. And I think we were trading at about $1.32 when I last looked. So just going to another question for you, Vince. I've got a question here from Graham. He's asked, you often give stock stories to show you what you would look for in a company. Having promoted the company's credentials publicly, how do you ensure you don't fall in love with the company and overlook its faults?
Thanks, Graham. Yeah, falling in love can be tragic sometimes. So you've got to be a bit careful. Look, because we are a quality and value manager, the value part's important. So we do value every equity and company we buy. So we play a pretty tight control over letting things run. You want to let things go if nothing changes about the business, but occasionally you'll get situations where the market will get well ahead of fundamentals. And because we're an actively managed portfolio, we will take advantage of what we consider to be mispricing on the upside as well. And while we still like the business and we still think it's a great long-term investment, we will be willing to manage around those core positions. Yeah, the valuation discipline is what stops you falling in love with things, but also weighing up on the other side, if I can stand on both sides of the fence, is that when you get a great company, it's sometimes you just hold on to it. Because if nothing changes about the management, the actual industry structure, either the returns are high, they've got a leadership position, etc., it's best to hold on to those for a while. But we tend to, once we get in positions where we think valuations are extremely stretched, we will take advantage of that sometimes because we want to pay dividends out that are franked, and sometimes, given the LIC structure, we can generate franking out of trading some of these positions.
Great, thanks, Vince. Another question for you. So this one's from Krishna. They've asked, why are you investing in an oil search company when we should be more in electric transport to reduce emissions?
I understand that some people might feel uncomfortable us buying oil companies. We're agnostic about everything, basically. we have a process where we assess ESG. It's an embedded process in our system. We've been doing governance for the last 40-odd years. So considering the E, S and G part as well, the E and S part it's fundamental to what we do. We have an ESG product internally, Perpetual's Ethical SRI Fund. So every company has we have an ESG score for, effectively. But with us, we're not an ethical fund, per se. We assess whether the ESG risks are priced into the into the price of the equity. And if we see something's trading well below its fundamental value, we'll always consider that as an investment opportunity. Now, with All Search, we bought quite a bit when it traded down to $2. There was an equity raising done at that price as well, which we participated in, because base was implying that the oil price will stay at $15 to $20 for the long term. We're trading at now the oil price is around $70. We're starting to see, I think, the fascinating decision 2 weeks ago where Shell was told, effectively instructed to decarbonise quicker than what they were willing to do. That plays into actually tighter oil markets if you're starting to see Western companies having to decarbonise a bit quicker, because we're still using 95 to 100 million barrels a day of oil, whether it's within transportation, aircraft, or just passenger vehicles. We're still selling, I think, nearly 80 to 100 million cars per ICE vehicles per year. So there's still a need. So we do factor in the ESG risk, and as long as there's a margin of safety in the valuation spread that we're getting, we will always consider buying any equity to us. So we don't have philosophical issues with companies.
Thanks, Vince. Question again for you, Nancy. We've had a couple of questions on the discount to NTA of the share price. So one relating to why we're raising money when we're trading at a discount, and then secondly, how we're looking to address the discount.
Thanks, Karen. Let's first talk about what we're doing about addressing the discount. We believe there's a time lag between the share price and the discount to NTA. So what the board focuses on are really three main drivers here. The first is investment performance, and just to pick out some numbers from the presentation, our performance for the past year to May 30 was 38.6%. That was, an outperformance of the benchmark by 9.9%, and so that should differentiate us from the other LICs out there, and people should start to take note. The second driver the board looks at is the annual dividend yield. It was 4.4%. The grossed up dividend yield for the last year is 6.1%, basing that on the dividends of 5.6 cents and the closing share price in May. So our performance there has really exceeded. And lastly, we try very hard to get these messages out through these kind of sessions, presentations, providing you with the daily NTA and monthly reports. So on to the first part of that question, though, Karen, why now? Why are we doing this now? As I think I mentioned earlier in the presentation, the manager thinks that there are incredible opportunities here. As you've probably seen in Vince's presentation, we're down to 1.7. We were 1.7% in cash. So Vince is putting the money out the door as fast as he can. And so we see lots of opportunities for growth out there. And if you think that through, the larger we get as PIC, the more the costs of the company get spread around the shareholders, so that reduces your overall cost to run the company. Thanks, Karen.
Great. Thanks, Nancy. Also, we've got a question, also one for you, Nancy, from, I think it's Barrett, or I'm not sure if it's Daryl, his first name, or Barrett, his first name, but he's asked, what is the expected gross yield relative to the ex-JO?
Well, let's see if I can do my maths really fast, huh? According to FactSet, the estimated forecast yield for our PIC portfolio is 3.01, and the forecast yield for the S&P ASX 200 or the S&P ASX 300 is 3.86%. But importantly, you have to understand when you're looking at PIC, the yield for the portfolio is really not representative of the dividend that the PIC board declares. With the LIC structure, we have the ability that the company can retain earnings, we can pay profits out, and then we can build up our profits and our franking credit balance. So that gives us that opportunity, so that comparison is probably not exact because of the input the board has on being able to declare dividends. I think I just mentioned the dividends for the last 12 months totaled 5.6 cents per share. That's 8 cents per share, taking your franking credits into account. So there's a difference in making that comparison that you have to be aware of, and that's one of the beauties, really, of the LIC structure, that we have the ability to do that.
Thanks for that explanation, Nancy. We've just had a couple of other sort of operational questions that I'll quickly answer before we finish up today. So we've had a question around whether the slides will be available on the website afterwards. So they will be. Both the slides and the recording will be available probably early next week on the PIC website, so please keep a lookout for that. Just while I'm talking about the website too, we do host a whole bunch of information on there, including our monthly reports, any ASX announcements, any other updates that we do, so keep a lookout for that, as well as the offer site for the SPP is also on our website, so you can go in and apply there. We also had a question just to clarify the record date for the SPP. So the record date for that was the 1st of June. So if you held shares in PIC on the 1st of June, you're entitled to participate in the SPP. And then the options record date is the 23rd of June. And importantly, that means that any shareholders that participate in the SPP are also eligible for the options, provided they continue to hold those shares until the 23rd of June. So thank you very much for your time and your participation today. We hope you all have a good afternoon. Thank you. Bye.